we discussed about international trade. That is where we are concentrating on. And we introduced ourselves to the the currency market. We discussed about different types of exchange rates. We talked of spot exchange rate. We also talked of forward exchange rate. We also discussed about cross exchange rates. We were able to discuss what is a buying price and what is selling price. And we were able to tell when you are buying and when you are selling a currency. So at least we introduced exchange rates and discussed a lot. And when you can say a currency is becoming weak and when you say a currency is becoming strong. That was just introduction to the foreign exchange, because that is where we are going to concentrate on most. So I assume everyone has access to the notes from the Moodle account, because I upload the notes before we meet for class for you to go through before we meet for the class. So today we are going to introduce about the risks. In our first class, the very first day, we discussed about the risks which are faced by firms who are doing international trade. I want us to remind ourselves, what are some of the risks these people are doing international trade as compared to someone who is doing domestic trade? For the new participants in the class, when we talk of domestic trade, is the trade within the boundaries of a country, and international trade is a cross-border trade. We have also discussed ways on which you can carry out international trade. We talked of licensing. We talked of the traditional import-export. We have talked of franchising. Another method, foreign direct investment. All those are ways you can carry out an international trade. So now today, before we start off, I want us to remind ourselves, what are some of the risks? Because now we are going to the finance part. As finance people, you are carrying out an international trade. What are some of the risks you face as a finance, or as a finance person, or as an institution, which needs your attention and management? Then we'll now be discussing how can you manage those exposures. We have internal methods, we have external methods for managing the international trade exposures. So I want us to remind ourselves, what are some of the risks which a company will face if they decide to go for international trade? What are some of the risks a company will face, or some of the exposures a company will face? What are some of the exposures? What are some of the exposures for international trade? We had mentioned this in our class. What are some of the risks which an international company will face? One, I need to get it from you because we have
exchange rate fluctuations.
Exchange rate
Fluctuations.
Exchange rate changes. That is one of the risks. Number two, what is the other risk which a company faces?
Political challenges.
Political challenges. There's political challenges because it will be affected by political challenges of the countries outside the boundaries. Another challenge, Galax A10, kindly provide me the admission number. I've said join the class with admission number, or else I'll start admitting only people who are joining with admission number. What is other challenge? What other exposure do companies face when they decide to go international? What other challenges do companies face when they decide to go international? Another challenge?
Cultural differences.
Cultural differences. There are cultural differences in different countries. There is government interferences. We have said that government will charge some specific taxes for people who are carrying out international trade. Government interference. Then number 5, what is the other challenge? Another challenge you can think of if you decide to go international. What other challenges are you likely to face?
There is the legal challenges.
There is legal challenges. You have to get a lot of documentation. There are legal challenges. Because for you to carry out international trade, you have to get a lot of documentation. What other challenge? What other challenge do you face when you decide to go for international trade? What other challenge do you face? We have already talked of 6. Now, I think those are enough. We had discussed them at the beginning of our class, at the other class, at the beginning of our very first lesson. Now, I want us to start today from how do we manage the exposures, and we are only going to concentrate on one exposure, which is the exchange rate exposure. I can hear some people are still not mute. If you're not talking, kindly make sure you mute yourself. If you're not talking, if you're not the one talking or you're not responding to a question, mute yourself. I'll allow you to unmute if you have a question or anything you have to mention. You can unmute yourself. So I want us today to start our class, and I shared the notes. It was about the exposures, and we are going only to concentrate on exchange rate exposure, because that's the one which relates to finance. The one of political challenges, cultural differences, and all that can be managed from management point of view. But the exchange rate exposure will remain. You cannot manage it. You can only try to hedge or to reduce or to minimize the effect it will have on you as a company. So you have 3 types of exposures when it comes to exchange rate exposure. You have 3 types of exposures. Hope everyone is able to see my screen. So we have just discussed the challenges which companies face when they go international. Some of them we have mentioned is political risks. There's competition. When you go international, you expose yourself to competition even with the local market. We have cultural differences, exchange rate exposure. We have government controls, shipping risks, and all that. There are so many risks associated with you going international. So those are some of the risks I've captured in my notes. If I will share them after the class. So we are going to concentrate. I want to ask a question before we move on. How many people watch business news in this class? What was in business news last night about import and export? You know me, I like watching business news. I don't like politics, but I watch business news. There was something which was being debated on in yesterday news about import and export. A given sector was complaining that we are importing more than we should, and that is affecting the local production. What was being discussed? Anyone who has an idea? You can unmute yourself if you want to talk. Sorry?
The sugar importation.
In the news, there was a discussion
The sugar
on
importation.
sugar. Yes, the sugar importation. The sugar sector, we are complaining that we are importing more than we need. Remember at the beginning of class, we had discussed on why we need to do international trade. And we mentioned something like absolute advantage and comparative advantage. We said sometimes demand and supply. So the guys were trying to explain that we are importing more and the local producers are able to supply. So we should not be importing. Those are some of the things you should be picking from the news to get to understand the international trade and understand the international environment. Because if you could see the guy who was being interviewed, he was very bitter and felt very affected because he was thinking that we are importing when we don't need to import. So it's like our demand is not more than our supply. It's just an issue of cartel satisfaction and all that. So keep watching business news because I will keep asking questions and you never know. Your exam is case study, so there's a possibility of me telling you to analyze the sugar import and export in Kenya. So you should click on all those things. So these are the learning objective. By the end of the class, you should be able to know the different types of foreign exchange exposure, because we are only going to concentrate on the exchange rate exposure. You should be able to know how to measure translation and transaction exposure. What are the 2 primary methods of converting foreign currency in financial statements, but that we are not going to get deep into it because it's the one which brings about the translation exposure. Then there are these hedging strategies. We have the internal and external ones. So that's the learning objectives. I was told that we need to know what we need to achieve at the end of the class. So when we talk of exposure, what do you mean? It means extent to which the company can be affected by changes in exchange rate. let's assume you have exported goods and you have issued an invoice. You expect a payment in the next 3 months. How likely that if the exchange rate goes down, you are going to suffer? To what extent are you not covered? That is what we are calling exposure. Maybe you have imported raw materials from outside the country and you're expected to pay. If the exchange rate, if the Kenya shillings becomes weak and the dollar becomes strong, how much can you suffer? How much are you exposed to such a risk? That is the exposure we are talking of. So we are talking of the movement in the exchange rates. So we have 3 types of exposures which come as a result of exchange rate, changes in the exchange rates. The first one is what we call translation exposure. Some books will call it accounting exposure. When we talk of accounting exposure, what do we mean? When we talk of accounting exposure, what do we mean? Translation exposure, remember we said one way of carrying out international trade, you can have subsidiaries in the other countries, and you have the home company in a given country. So what happens at the end of the year, those guys who have interacted with the international books of accounts, at the end of the year, you have to convert all the books to the home currency. Remember, some of them are trading in Tanzanian currency, Tanzanian shillings. Others are trading in Ugandan shillings, so they are keeping records in Ugandan shillings. But at the end of the year, because the mother country is in Kenya, all the books must be converted to the home currency, that is Kenyan shillings. At which rate do we use to convert those books? Anyone who has an idea? Anyone who has an idea why we need to convert the books and what rate do we use? Because this is not really a loss. It's only a loss in the books of accounts. It's accounting. That's why it's being called an accounting exposure. Because if you have a business which is operating in US dollars, another one in Ugandan shillings, another one maybe in Russian currency, at the end of the year, for audit purposes and for consolidated books, so you have done consolidation somewhere in accounting, you must convert them to home currency. What rate do you use to convert those books to home currency? Those guys who are dealing with accounting in foreign currencies, what rate do you use? Anyone who has an idea? I remember I said I like classes which talk. Sitaki class yenye imenyamaza kabisa. I also need to know that I have people. Anyone who has an idea? Anyone who has an idea which rate do we use to convert the currencies? Anyone who has an idea?
Can I try?
Yes.
Some transactions are converted
Yes.
using the rates at the beginning of the year, and other transactions are converted using the exchange rate at the end of the year.
The recommended rate, let me just now, I think she has tried. The recommended rate for converting books of accounts for any foreign branch is the mean. That's the average of the exchange rates on the 31st of December, midnight. You get the average. You know, there's usually the buying and the selling. You get the average. That's the recommended rate. Any CPA in the house can correct me if it's against the IFRS, but that is what is recommended. That is the recommended rate. So at the point of conversion, there's that challenge whereby you'll have issues of translating the books. Maybe the exchange rate at the beginning of the year was 120. Maybe it's Kenyan shillings against the US dollar. Then you realize that at the end of the year, the rate
Mwalimu, Mwalimu, you are breaking too much.
there's someone.
I don't know whether it's my internet.
There's someone disturbing me on the phone. Excuse me, I just respond to them, please. There's someone who is calling the phone and is the hotspot I'm using. So allow me to respond, then I'll be back. Sorry for the interference. I think that was the only solution because they was trying to call me on my line. So I want us to continue. Am I clear enough? Everyone can hear me? Hi.
Yes, yes, you're clear.
Yeah, now
I'm
you are.
clear. For the interference, I apologize for that. So I want us to continue.
Okay.
I was just explaining what is a translation exposure. And I was saying that the recommended rate is the average of the midnight of 31st of December. That's the commonly used rate. Unless it's against the IFRS, I'm not very sure, you need to confirm. But the thing is, the exposure comes because let's assume at the beginning of the year, the rate was 120. At the end of the year, the rate goes down to 100. It's likely to understate some of the values, like the value of the assets. It's likely to understate its value because of the conversion process. That is what we call translation exposure. It's not a very risky exposure because it's just in the books of accounts. It's not an actual loss. So it's not an exposure we'll concentrate on how it is managed, because with the translation exposure, there's nothing you are losing as a company. It's only the books of accounts will be understated. So it has its own challenges because it can understate some assets, which maybe you would have used as a collateral for loans and all that. But now we are moving to what we call transaction exposure. We have what we call transaction exposure. Transaction exposure, which is the one we are going to concentrate on most. Transaction exposure arises whereby you get into a transaction. Maybe you have bought goods, you have issued an invoice and you're expecting to be paid in the future. Or maybe you have been issued with an invoice and you're supposed to pay in the future. That transaction is open. It can be affected by the movement of exchange rate. So it stems from the possibility of incurring exchange gains or losses. There's a likelihood that the exchange rate might move to your favor, or it can move against you. If it goes to your favor, you are likely to make profit. If it goes against you, you are likely to make losses. What do you mean going against you and for you? Let's assume you have issued an invoice. I think I have an example in the next page. There's an example in the next page. Let's assume you have issued an invoice. Assume you have issued an invoice. If a company in Kenya exported goods worth $10,000 in March 2020, and they are due to receive their payments by end of June. You have issued the invoice and you are supposed to receive your payment by the end of June. The exchange rate when you are transacting was 100 for 100 Kenya shillings for every $1. The exchange rate at the time of the payment is at 99. Let's assume you have done nothing to manage that exposure. I want to share screen where I can write. So a company in Kenya, they have issued an invoice of $10,000. The exchange rate at the time of transaction, the exchange rate was $1 equals to 100 Kenya shillings. So from the time of transaction, the amount you expect to get is $10,000 times 100. Let's assume they pay you immediately, you give an invoice, and you're in Kenya, so you'll end up with 1 million. That is the amount you would get. But because you are not being paid immediately, then you are waiting for the next 3 months, you are being paid in June. Now come in June, you realize the exchange rate is $1 equals to 99 Kenya shillings. How much money will you get? You get 990,000. So you'll have lost, if you just leave the market to manage the transaction for you, you'll end up losing 10,000 Kenya shillings. You'll have a loss of 10,000 Kenya shillings. So if you leave everything without managing the exposure, you are likely to lose 10,000 Kenya shillings. Let's assume this is against you, so you are likely to make a loss. Let's assume it goes for you, it goes to your favor. Let's assume it goes to your favor. And now the part B of it, what is the transaction exposure is 10,000, you're exposed of 10,000. Let's assume the rates, it goes to 1 or 2. It works for you. The Kenya shillings loses value and it goes to 1 or 2. How much are you likely to get? How much are you likely to get? Let's assume it works for you and the Kenya shilling becomes strong and it goes to 1 or 2. How much are you likely to make? You have issued an invoice of 10,000 times 1 or 2. So you are likely to make 1 or 2. You are likely to make a profit of 20,000. So with transaction exposure, it can go to your favor, it can go against you. And that's why when we'll be discussing ways of hedging or managing the exposure, we'll discuss methods which will allow you to take advantage if it goes to your favor. There are some methods of hedging or managing the exposure which can allow you, if the rate goes to 99, you can use the hedging method and get the transaction protected. If it goes to 1 or 2, you can use 1 or 2 and opt to do away with the hedging. So when we'll be discussing the hedging method, have this in mind. It can either be to your loss, it can be to your gain. Some methods will allow you to take advantage if it is to your gain, and you'll be protected if it is to your loss. So those are that's the transaction exposure. When we talk of transaction exposure, that is what we mean. Hope we are together up to there, because that is the exposure we are going to discuss most. The third kind of exposure is what we call economic exposure or operating exposure. Some books will call it economic, others will call it cash flow, others will call it economic exposure. This one, I don't know. The best way to explain economic exposure is for someone who does cash flow projections. Cash flow projections, you are projecting that this amount you'll make, but it's affected by changes in exchange rate. Like now, the transaction we were just using up there, I would expect the accountants in that firm would use the current rate to project that in the next 3 months, we'll get 1 million in our cash flow because we have already issued an invoice. That is the projected cash flow. You know that we project cash inflows and cash outflows. So that is what you projected you will get. But because of changes in the exchange rate, you end up getting 990. Your cash flow projections are also exposed. Maybe you were imagining that you have imported some raw materials, you are supposed to make payment, that is cash outflow. You were paying when the rate was 100, so you would have paid 1 million. Let's assume it is the other way. You are the one paying, you're not the one who is getting the payment. You are projected that you were to pay when it was at 1 million. Something happens and that the rate goes to 1 or 2. So you pay when it is at 1 or 2, you spend 1,120,000 shillings. That is affected cash outflow. So with operating exposure is all about inflows and outflows being affected because you use the current rate to project, but the rates are likely to change. So that is what we call operating exposure. It can be a cash flow exposure. Other books will call it economic exposure. Now, up to there we are together. Any question? Any question? I want us to move to hedging. I've shared the notes. I think the notes I've shared are a bit comprehensive compared to what I have here. So the next thing we need to discuss is hedging. Now, managing the exposure. At least you understand we have 3 types of exposures. That is translation exposure, transaction exposure, and economic exposure. While the two of them we said they're just record exposure. But one is very risky, like the transaction exposure. So what do we do as finance people? Now we go to hedging. I might not be able to pronounce that H because of where I come from. So just get it as it is written there. Hedging, which is the process of managing exchange rate exposure. When we talk of hedging, we mean the process of managing exchange rate exposure. How do you manage, or you just leave it for the demand and supply to manage your risk? Or is there a way something you can do as a finance department or as an accountant to intervene and manage the exposures? There's some people who are not on mute. I can see I can hear a background kadogo. Let me just mute. If you're not talking, it's only Claire who should be not muted, so that she can tell me when I get lost. So when you talk of aging, is how do you manage the exposure? We have discussed the exposures which are likely to be there when you are carrying out the market or whatever international trade. We have discussed the how to carry out the international trade. Now finance comes in at this point. What can you do as a finance department or as an individual if you are carrying out international trade as a solo proprietor? What do you do to manage the exposures? Because they are there. Exchange rate will keep moving. Today it can be to your favor, tomorrow it can go against you. What do you do within your company and outside your company to manage the exposures? So I understood the reasons why we have to hedge. First is to minimize the translation exposure, minimize the fluctuations in the cash flow projections, minimize transaction exposures. It's just to manage those exposures specifically, but as we are going to concentrate on managing all the transaction exposure, those are the objectives. Also to avoid surprises. Maybe you are supposed to pay $1 million and you have $1 million in the account, and as management, at the end of the 3 months, you are told we need 2 million to pay. Reason exchange rate has moved. You need to be certain. Remember, you were discussing something and we said some of the, we were talking of different regimes of exchange rates or systems, and we talked of the fixed one, and we said it gives certain returns to investors. So you will avoid surprises when you protect yourself or you hedge against those exposures. Someone is raising their hand. Maurice, what is the issue? Maurice?
Just trying to say.
Yes?
Trying to say.
Yes?
You get me?
Yes, I'm getting you. Go on.
I'm trying to say one of the strategies that you can use to mitigate exposure.
Yes?
Like one maybe operating a foreign currency, maybe say you're operating in a country where you use a dollar.
Yes?
So you open a dollar account where
Yes.
you can keep some currency for that particular country you're trading in, so that you don't need to buy currencies every time you want to pay an index.
Yes, when we talk of it, there are no methods of managing exposures or managing the currency exposure. One of them is actually operating an account in the foreign currency. If as an organization, you know that you frequently make payments in US dollars, you operate an account which is in US dollars, so you will be holding the cash in the currency you use mostly. Just a minute. One of the methods Maurice is bringing up is you can open an account if you frequently use dollars or you are frequently paid in dollars. You open an account which will run in US dollars. So just go to your bank, if it's KCB, open an account there which will run in dollars. So what happens if you have to make payment? You don't need to convert the money. You don't need to buy the currency at that point. You already have it in that form. What happens if you are receiving payment? Let's assume it's like the exchange rate is not favorable. You can receive the payment in that account in US dollars, hold the money there in US dollars, and when the rates are favorable, you convert for use. That is one way of addressing it. The other method is what we call leads and lags. The other method is what we call leads and lags. What do we mean by leads and lags? So I want us to discuss, so I don't want to have the notes. The first method we have agreed is to have a bank account in foreign currency. The second method is what we call leads and lags. What is leads and lags? What we mean by leads is you pay early. Pay early. This one is you delay in payments. How do you determine whether to pay early or to delay in payments? Let's assume like right now, we are in June. we had seen that the exchange rate for dollar is $1 equals to how many Kenya shillings? It was 101 the other time. Let's just assume it's 101 Kenya shillings. You are issued with an invoice which you're supposed to pay in September. What is likely to happen between now and September which will change our exchange rates? What is likely to happen between now and September which is likely to affect our exchange rate? Anyone who has an idea what is likely to happen to the economy which will affect our exchange rates? We expect our economy to have opened up by that time, by September. So right now the rate might be at 110. Let's assume it's at 110. Let's assume the rate is at 110 Kenya shillings. It's likely to come down by all means by September if the Ministry of Health allows us to open up the economy. Let's assume it's 110. So from the finance point of view, someone who is following up the exchange rate and the economy movement, we are very sure that if the economy opens up, this rate is likely, it might not improve that much, but it's likely to go to 105. If the ministry doesn't open the economy, we expect this rate to worsen to 115. Now, they will announce before then. They will announce maybe by the end of the 30 days they have given and say that they are opening up. So what is likely to happen? The rate is likely to go to this. So you are supposed to make a payment in September, or you're supposed to receive a payment, to make a payment in September. Then you predict that the rate is likely to go to 105 and right now it's 110. Do you pay early or you delay in payments? I'm asking a question.
You
Do you
delay.
pay early or
You
you
delay.
delay in payment?
You delay.
You delay
You
in
delay.
payment, hoping that the rate will go to 105. Even if you were to pay in August and you are seeing that by September the rates are likely to go to 105 from 110, you delay in the payment. That is what we call lines. Or if you see that the rates are worsening, if they decide they are not opening up the economy and you expect the rate to go to 115, what do? You pay early, you pay now at 110. Because you can tell them maybe you have gotten some money from somewhere and you want to settle the debt. So you pay early because you are predicting that the rates are likely to go to 115 from 110. So you are likely to suffer loss. So what do? You pay early. So that's one method, Lease and Langs. The third one is, which method can we use? Invoicing is what we call invoicing. What do you mean by invoicing? When you're issuing your invoice at the beginning of the transaction, you can decide to issue invoice in your local currency. You don't issue invoice in foreign currency. If you're in Kenya, you tell them, I expect a payment of 1 million Kenya shillings. You don't say that I expect a payment of 10,000 US dollars. What does that one mean? It is them to incur the cost. You have shifted the charges to them. You have shifted the charges to them. So they are the ones who will change the currency to Kenya shillings regardless of the rate. So you invoice in your local currency. You insist invoicing in your local currency. The other firm on the other side is the one which will incur the cost of translating the cash to your home currency. This is not really very practical, but with some countries it can work. If you're invoicing, you're in Kenya and you're invoicing someone in Uganda, you give invoice in your Kenya shillings. It is them who will suffer the changes in exchange rates. You will have shifted the exposure to them. Which other method do you think you can use? Which other method can you use? Which other method can you use? There's what we call matching. Is what we call matching. What does matching mean? You make sure that today, if I borrowed, if I have received raw materials, I'm supposed to pay 31st of September of 10,000 US dollars. Those are raw materials, so that's a receivable, a payable. I'm supposed to pay. Someone is joining the class. So if I've received an invoice on the first, I'm supposed to pay that 1st of December. I also issue an invoice to someone who should also pay. These are payable. These are payable. I make sure I also have a receivable maturing the same date. I also make sure that I have a receivable maturing the same date of the same amount or more amount, maybe of 15,000 US dollars. This was 10,000. I make sure that I have a receivable maturing on the same date. So what happens when I'm paid on that 1st September, assuming the other party will give to the date, then I'll just use the same US dollars to settle my payable. So I will not need to transact to change the currency. If the amount I'm expecting is 15,000, then it means I'm partially exposed. My 5,000 will still be exposed, but at least the 10,000 will be covered. Once I receive the 10,000, I'll just use it to pay the supplier who had supplied to me. So I will have no transaction of changing currencies to local currency and all that. That is what we call matching. There's a fifth method which is called netting. There's a fifth one which is called netting. What do you mean by netting? It's there in your notes, which I shared. What is netting? What do you mean by netting? What do we mean by netting? What do we mean by netting? What do we mean by netting? Anyone wants to attempt? What do we mean by netting?
It is like balancing of the accounts. Is it?
It's like balancing of my accounts.
The accounts, maybe you are trading in the same company, maybe you trade together, you are an exporter and is also an importer for you. So you balance off your accounts statements.
Yeah, when you talk of netting, he has an idea. Is whereby, let's assume you have a subsidiary. You have a subsidiary which makes payments in US dollars. It has some payments to make on 31st. And you have a mother company or the other subsidiary. It also has some receivables. You make sure that all the receivables and payables, you net them off. Maybe you have receivable in US dollars, the other company has payable in US dollars. So you make sure you net them off. You only remain with what cannot be netted off. The way he has explained, balancing off the books. You make sure all the receivables and payables in dollars, they net off until you remain with what cannot be netted off. If they are in maybe pounds, you make sure that all the receivables and payables in pounds, they net off. You don't leave, you are only going now to hedge whatever remains. You are told that maybe one branch, let's assume one branch is likely to receive some payment. Nairobi branch is supposed to receive some payment, so these are receivable of 10,000 US dollars. Then maybe Machakos branch, they have a payable. They are supposed to pay for raw materials which they were supplied of 5,000. Maybe another one in Kisumu branch. They have a payable of 2,000. Let's assume another one, Kitengela, has a receivable. They have a receivable of maybe 1,000 US dollars. So you net them off. Whatever Nairobi they collect in dollars, 10,000. You use those dollars to pay for Machakos, to pay for Kisumu. So whatever remains exposed, so you will use the 10,000 to pay these 7,000. So you remain with 3,000 receivable plus 1,000. This is what now you'll get a different method to manage it. You know, if it was now each branch to manage their debt to hedge on their own, remember some of the hedging methods have a cost implication. Some of them you have to pay some premium. So if each company had to decide to hedge on their own, it will mean you incur cost to hedge these, and these and these. So what do? You net them off. That is where now the netting comes in. Then you are only remaining with what cannot be netted off to hedge, which is 4,000. Hope we are together up to there. Which other method can we use for hedging? Which other method can we use for hedging? Anyone has another idea? Is there another method we can use? Internally, not now externally. External methods we'll be discussing, but I'm saying within the finance department, what else can you do to manage the exposure? To make sure that when the money comes, you don't convert it, or even if you convert it, you convert at a given rate, which is sure, it's not something you will be affected. Any other method? Any other method? Those are some of the commonly used internal methods. Those are some of the commonly used internal methods for managing transaction exposure. Think here.
Mwalimu, I have a question.
Yes.
Now, what is the difference between matching and netting, because they seem similar?
The difference is only one. Netting, you are netting off debts with different branches. This is where the company has different branches. So you are netting off receivables of different. The first guy who had explained, maybe you have a department which does imports. We have another subsidiary which does exports. So you are matching debts and receivables and payables of different branches or subsidiaries. You net them off. That is like you wait now, assume Kisumu Kambas operates in US dollars, assume Nairobi operates in Kenya shillings, Kitegela in another currency. So you are trying to match all those. You know, normally in accounting, those things should not be paid from the other branch. It's now like saying Kisumu will collect their fee and they use that fee to pay the staff in Nairobi because staff in Nairobi are paid in US dollars. That is what we call netting. But now matching is within the company. When you are issuing an invoice, you are issuing an invoice for a receivable, you make sure you have a payable maturing the same date you are being paid. It's just within the company itself alone. That is the only difference. They are more or less the same. We'll also be talking of money market engine, which will also sound like matching, because it's still creating a receivable to match a payable. But now that is external. This is just internal. You make sure that the date I'm getting paid is the same date I should be paying. So I just use the amount I'm paid to pay. But here you're trying to manage your debts and whatever receivables and payables, even within the branches. You look at Kisumu, they are collecting 1,000 US dollars. We have staff in Nairobi who should be paid in US dollars. You use the US dollars in Kisumu to pay staff in Nairobi. And maybe the money you collect in Nairobi, you use to pay Kitengela, because that is where they are paying in Kenya shillings. That is the whatever you call netting. It should be across subsidiaries. But matching is within one subsidiary. You decide now as KCM and campus. Is the time students pay fee. We try to collide it with the end month for us to be able to pay our responsibilities also. Let's assume we are operating in foreign currency. It would mean that we are not converting to Kenya shillings to keep it to weight. You're only paying as we pay. That is the difference. So those are some of the internal methods. I hope I'm clear on that. Those are some of the internal methods you use for managing currency exposure. And that is transaction exposure is the one we are looking at. We have external methods, which I know we will just introduce. We have external methods which you can use to manage the transaction exposure. Is there anyone who is doing financial risk management in the class? Anyone doing financial risk management? Anyone doing financial risk management? That is where you'll talk more of derivatives. That is where you'll talk more of the derivatives. I remember in the other class, I mentioned something like speculators. Derivatives are known to be used for speculation purposes. You hold them, expecting that market will move to your favor and you will dispose them to make profits. But you can also use derivatives for hedging purposes. The reason why I was asking, so I don't want to confuse you, because I know from the risk management or the financial risk management class, you are looking at the same derivatives, but you are looking at them as tools for speculation, not as tools for hedging. In our class, we are going to discuss some derivatives which you can use for purposes of hedging your transaction. So that is the difference I wanted to make clear. I know in the other class, we'll be talking of derivatives as speculation tools. But in our class, we are looking at derivatives as tools for hedging against transaction exposure. So the first derivative we are going to discuss is forward market hedge. Forward market hedge. Anyone can remind us what is a forward exchange rate? What do we mean by forward exchange rate? Because we talked of spot exchange rate, forward exchange rate, and the cross exchange rate. Someone to remind us, what do we mean by forward exchange rate? Because that is where we get the forward market edge. Someone to tell us what do we mean by forward exchange rate? Anyone who can remember what we say the forward exchange rate is? What do we mean by forward exchange rate? Because that is where we are going to get the definition for forward market edge.
Can I try?
Yes, go ahead.
It is a rate that is agreed upon by two parties now to be exercised in future, at a future date.
Correct. Forward exchange rate is a rate which is agreed now to be exercised in future date. So I had explained it clearly in our last class that you go to the bank. If you are a corporate banker, of course, you have your manager who manages your accounts. You go to the bank, you know that in the next 1 month, I'll be paid this amount. So I will need to sell this currency locally. I will need to sell this currency locally. So what do? I go to the bank, tell them that I'll be paid 10,000 US dollars by the end of September. At what rate will you use to buy them from me? Then you agree on a rate, it's a contract. You agree on a rate, which is binding. Then when now the time comes, you are paid the 10,000, you go to the bank and exchange at the agreed rate. So when you talk of forward exchange rate, we mean a rate agreed now to be exercised in future. It all depends with the predictions. The bank, of course, has to predict. The same way I was telling you, you must work around. Maybe what is the major economic activity which is likely to happen, which will push the rates, and how are the rates expected to go? Those are the things you have to, but the bank has to balance before they give you the forward exchange rate. So when we talk of forward exchange rate, we'll be doing computations in our next class, or we can do something today on forward exchange rate. Trying to see whether I have an example on forward exchange rate. There's an example here, but I wanted to do it in the next class because it will take a bit of time, but I can just give a simple illustration of what we mean by forward exchange rate. It's the simplest method of hedging, and it will depend on how you relate with your bank. So let me just give an example. We'll work on the comprehensive example when we have done all the derivatives. So we can get an example which involve all the derivatives, then we'll compute. So when you talk of forward exchange rate, we'll be discussing, I can just mention the derivatives we'll need to discuss, then we'll continue, we'll do the computations next class. So when you talk of forward exchange rate or forward market edge or forward contracts, some books will call it market edge, other books will call it forward contracts. What you go to the bank. Let's assume a company in Kenya is expecting a payment, of 10,000. I like using an example with round figures, 10,000 US dollars by 31st September. Then you go the spot rate. Now I'll use the terms which we were discussing in our last class. The spot rate you are given is 101, 102. Someone can remind us what this means? Someone can remind us what this one means? What is 101? What is 102?
101 is the buy rate, 102 is the selling.
So you are told that, correct? You are told that the 3 months forward rate, I need to clear something I have written wrongly. You are told that the forward rate, just a minute, I need to clear all this, it's a lot. So you are told that the forward rate, let's start again. You are expecting a receivable of 10,000 US dollars. Spot rate you are given is 101, 102. Those who are in class, you can know what is buying price and what is selling price. Then you are told 3 months forward rate. You go to the bank and this is what you discuss. It's 100, 101. That is the contract you have been given. The spot rate in September, it happens to be, let's assume 99 and 100. Now, you have already gotten into agreement that are you buying first or you are selling? You will be getting a receivable, you'll be paid 10,000 US dollars the next 3 months. The spot rate as at now is 101, 102. 3 months forward rate is 100, 101. And the spot rate in September, let's assume now when you get to September, the rate is 99 and 100. First of all, you need to understand, are you buying the currency or you are selling? So let's assume you opt to take the hedging method. You decide that you take the forward hedge. You decide you are going to take the forward hedge. So how much money will you make from the 10,000? If you decide to take the forward contract, you decide to get into the forward contract, how much money are you likely to make? At what rate will you exchange your currency? Remember, we said this is buying, this is selling. So how much are you going to get from the forward contract? Let's assume you decide to buy the contract. You decide to get into the contract with the bank that in September, I'll come with the 10,000 and you should exchange it at 100 buying price, 101 selling price. What are you likely to make from the 10,000 US dollars?
1 million.
1 million. Reason?
1 million.
You are the one selling. Are we together?
Yeah.
Yes.
The rest of the class, you are the one who is selling. So
Selling.
the bank will use which rate? The bank
100.
will use this rate. Now let's assume you don't take the hedging and decide that I will not take the hedging. I will wait for that day to come. Then I will just change my currency at the prevailing rate. That this is when you take the forward contract. Let's assume you decide you're not taking the forward contract. You just wait for that day, and whatever will happen is what you'll use. What will happen? You will exchange at what rate?
99.
Times 99. So you are likely to get, you are going to get 990,000. So if you use forward contract, if you get into the forward contract, you are going to get 1 million. If you decide to remain unhedged, you wait for the market to do whatever it wants, you'll get 990. So you'll have lost 10,000. That's why we are saying as finance, we should be able to advise what the rates are likely to go to which direction, and should we take the hedging or should we just wait for whatever comes. So if you decide to take the forward contract, you go to your bank, discuss with them, this is the amount I'm expecting to get, and I want to sell it to you. At what rate will you buy in the next 3 months? You agree on the rate. That is what we call forward exchange rate. And if you get it in this case, you are going to make 1 million. If you remain unhedged, you are going to get 990,000. The unhedged position is not that it will make losses all through. Things might not work out and the rate might go to your favor. It might go to 102, 103. This might be the buying price, this might be the selling price. It's not that all the time if you don't hedge, you will make losses. We said that you can make losses and you can make gains. When you are keeping books of accounts, there's what we call foreign exchange gains and foreign exchange losses. They arise because of the transaction exposure. So if they go to this side, if the rates go to this side, then you are going to make more money than you expected. You're going to have 1,120,000. So it can go either, but this one is not certain. This is not certain. This is not certain. You're just hoping it will go that way. But if you get to the contract, this one, you are sure this is the amount you are going to get. So you can plan with it, you can plan investment with it, you can be able to accurately project your cash flows. So if you get to the contract, you can know after 3 months, you are going to get 1 million. When you remain unhedged, you can either get 990, you can either get 1,020,000. It can go either way, so you cannot comfortably project what is likely to happen. That is what we mean by forward contract. That is what we mean when we talk of forward contract. We are going to discuss other, I don't know whether there's any question on that. That is the simplest derivative you can use for hedging. I know speculators will, when you are doing financial risk management, you will discuss it as a speculation tool. But for our class, we are using it as a risk management or transaction management, the exposure management. So the second method we are going to look at is the future contracts. These are external methods. I've divided them in my notes. So when you talk of external methods, let me just a minute. When you talk of internal methods, I want to make clear for those who are taking notes. Internal methods is what you can do within the company, is what we had discussed before. First was the account issue, bank account. Second was invoicing, for those who are taking notes. Third was netting. Fourth, we talked of matching. That is what you do within the company. It does not need any market, any bank or any stock market interventions. With the external methods, we have talked of forward contract. We'll discuss about future contracts, which is more or less like forward contract. We'll discuss future contracts. We'll discuss currency swaps. I'm mentioning for you to be able to read before the class. We'll discuss currency swaps. We'll also talk of currency options. Then what we call money market hedging. Money market hedging. Those are some of the external methods you can use. These are the internal methods. So with the external methods, we have discussed what is forward contract. I don't want to introduce any of these before the next class because I want us to talk of 3 of them. Then we do a comprehensive example. So I want to get any question or comment or any concern so that I can call it a clear day for today. Because with the external methods, I want us to do 3 of them and then take an example the same day. I don't want to get to them and then we don't do an example. From my notes, I will be sharing on the Moodle. I know the other ones I shared in Word, they are a bit comprehensive. We'll be seeing the external methods and the internal methods. The externals are the ones on this side. I think I need to put as a topic somewhere. There's the external methods and the internal methods. So I will just enter it and I will share with you. We'll be talking of forward market. We understand what is forward market range. We'll be talking of the future currency contracts. We'll be talking on currency options, money market hedging, and currency swaps. We'll have like 2 classes on this because it has a lot of computations. So kindly, if you know anyone who has not started this class, tell them to join the class because now we are getting into the real international finance. That's why I don't want to take the example today because I need us to discuss the rest so that we can take the example comprehensively. I will share the notes with you. You can give it an attempt before we meet. Any question or concern? Any question, concern, comment? I would wish to announce that everyone in the class has registered. You are paid something. The reason I'm just leaking you information because I'm in finance. I know soon you will only access the platforms for classes if you are duly registered. So kindly make sure that you are duly registered. This is an announcement we are making to all classes. I'm not the only one who is making it. If you have not met it, your lecturers will communicate that from
What do you
July
mean
we'll
by
have worked on the modules.
duly registered?
You register, make first installment payment, or make arrangement with the finance office to make sure that we talk of you have committed. I think you have received some text messages saying that you validate your registration. You know, you cannot assume people are there and they have not paid and they have not committed, because maybe they are not there, they are there. Those are some of the issues we are trying to address. So if you have issue, you can get me inbox. You are lucky that you know me. Get me inbox, let's discuss your registration and let's regularize it if there's any issue. Because I don't want to give a card, then I realize some of my students did not take the card because they are not registered. So make arrangements to do that. I will appreciate. I don't like, you know, now it puts me at a very awkward position to be chasing a student I'm teaching. Watu watafikiria siwaambii kama bado ni mimi nitawafukuza. So make sure you talk to me. I don't like fighting with my own student that namfukuza tena. If you have a challenge, let me know. As long as you are decided to go on with the semester, we will support you through. That's the only announcement I have from the administration. The other one, I'll talk to Claire. Claire, I will need us to keep class register because we have to account for people who attend classes. Now we are getting serious. We are just testing waters and we have seen you guys are supporting us. So now we are getting to the real mood of class now. So we need the class registers and all that. Any concern, question, comment? People from the lake, are you in the class?
Yes, Mwalimu, we are here.
Okay, it's only you, Victor. There's no other person from Kisumu?
I'm here.
Okay. Morris. Okay.
Concern, eh?
Yes.
I think I can speak on behalf of those who have not submitted their assignment 1. Eh?
Yes.
I think we had some mix-up with the registration and everything, and maybe confusion about the system and everything.
Mm-hmm.
So kindly, can you extend for us like 2 or 3 days? That's just enough for us to
I will
submit.
open the 2 immediately after the class up to Saturday. I assume everyone by Saturday should have submitted.
Okay, thank you.
Another comment?
Thank you.
Question? Karibu. Another comment, question, concern?
Those tests.
I think we can call it a day today. Then we'll meet for the next class. Kindly make sure you go through the notes before we meet for the next class.
Kenyatta County Assembly, Honorable James Murango.